an expert.
Well, good morning. You're watching Indian Open right here on BloombergQuint Live. This is India's first live streaming business news services, and we are 4 minutes away from Market Open. I'm Neeraj Shah, and Devina, suffice to say, we'll start off in the red.
Of course, Neeraj, that goes by anybody's guess right now. Looking at the SGX Nifty, which has actually dipped a little bit more since the last time, in the last 15-20 minutes at least. So now we are sub 8,900, 8,899. At one point, the SGX was down 1,000 points. From there, it's been a decent enough recovery. Let's bring in our guest on the show, Narayan, founder of Renisa Capital. He's joining us on the show. On the technical side, we've got Shrikant S. Chouhan, Senior VP of Technical Research at Kotak Securities, with us in the studio. And Shubham Agarwal, CEO of Quantsapp.com, also joins in. But we just have 2.5 minutes left to go. Samir, a quick take from you on your assessment.
Good morning, Devina. I think, as has been discussed, obviously the sentiment is probably at its nadir, but the fact is that these are the times where probably the price is the best, because we've seen such so-called Armageddon earlier as well. But thankfully, the market comes back, and maybe right now the price is actually not discounting reality completely. I mean, you had decent data points come up in terms of falling inflation, growth numbers again perking up in Feb. So these are important things on the horizon. Your CAD is very good, and it's probably likely to get better in this quarter. So I think those are important things. Oil is a big plus for us, but right now everything is being ignored because right now, honestly, nobody knows. So I think that's where currently we are. So the prices that you get today, as we roll forward, maybe you'll, in hindsight, look back and see, oh, that was a time to buy. But right now, yes, it's complete fear.
Okay, quick thoughts, gentlemen. Shrikant, quick 30 seconds. We'll start off lower. Would you initiate any trades?
Till yesterday there was support in the market because 96.50 was the real genuine support for the market. But now after this, when the market is opening below these levels, now we need to watch levels. Until the reversal is not coming in the market, we cannot initiate any specific trade.
Yeah. Shubham, what about you?
Good morning, Neeraj. I guess of the same view, we shouldn't be looking at any trade in the opening bell because it's a big gap. I think we need to look at the market after it opens as to whether we have any signs of stabilization or not.
Okay, so it's very difficult to give a call at this point as well. So don't want to put our technical analysts in a fix to give calls which could go wrong at this point. The pain in the markets and the ferocity of the sell-off, as we all know it, has been immense. 1 minute, under a minute left to go for market pre-open. Just stacking up what the rest of Asia is doing, Nikkei is down about 8%. So, and Hong Kong too is down 5.5%. China not so much. Remember, there is a ban on short selling in China, so that's why you're not seeing the kind of aggravated reactions coming in to the Chinese equity markets as well. So, for the SGX Nifty, closer to about 6% lower. Watch out for the likes of Yes Bank in today's session. And now we've got a larger number that SBI is going to pump in for its 49% stake in the bank. That's 7,250. Yesterday's session saw Yes Bank correcting 11.5%, but that was not all that sharp. Today's session could once again see a leg up for this one. For SBI, which nudged nearly 250 and below, this is tough times for the Nifty Bank, which had its sharpest fall in yesterday's session since October of 2008. Pre-open on your screens, the first tick leads you down by 5.5% on the Nifty 50. That's a 9,000 broken, breach down below. 32,358 on the Sensex, which is not reacting as much. Remember, our first circuit breaker, but that happens at open, comes in at about 8,611 odd. So, watch out for that one. Individual stocks, starting off with Adani Ports, which is down about 10%. The likes of a BPCL, 7%. Remember, BPCL was one of the top losers in yesterday's session, 15% drawn down. ICICI Bank is showing a 10% cut. Bajaj Finance at 3,300 right now. This is pre-open, guys. So just, hold on. IndusInd Bank at 706. Hero Moto, Z, you've got HCL Tech down 10%, Tech Mahindra down 10%. I think the top 15 stocks are all down 10%. Britannia is looking lower. Coal India announced an interim dividend of 12 rupees. I think the expectation was 21, but this is nonetheless decent enough. Reliance Industries just at 1,000. I mean, open could actually it's below 1,000 now, so 999 for Reliance Industries. The rupee, I don't know whether it's already hit that new low, because the record low was 74.39. We're at 74.3, but I know we already hit that and came back. I think we're at record lows for the currency.
Yeah, it's not looking good. Broader end of the spectrum too. Almost everything will be showing red. I just want to mark one yes bank, to be honest, and then wait for these pre-open rates to just settle at 8 minutes to tell you what could come off. For almost everything which was strong is showing some really large downtakes. The Godrej Properties, Deepak Nitrites of the world. I don't think money is distinguishing right now between the good, bad, ugly. Maybe at some point of time it will. For now, it probably is not. Watch out for the bond yields as well. That's the other thing that you need to monitor. But we'll revisit these rates in a bit. For now, about 6.27. I must say the yields have hardened a bit in the last few sessions. Yesterday, we opened at about 6.15. Currently, at about 6.27. Let's wait and watch what happens. Typically, as we were discussing as well, bond markets tend to react a lot faster than what equity markets do. However, taking the conversation back to our experts, Samir, this too shall pass, and everybody says that, and therefore I'm bored of that. So I'm asking you, if you indeed believe that these are good levels to buy, or these are good levels to start putting in money, and I'll hold you to the answer when we meet 2 weeks from now as well. Where is it that you would look to put in money? I'm not saying that you will put all the money today. But if you were to stagger out your purchases as well, having analyzed the fundamental impact that could happen because of the virus and the economic lockdown, so on and so forth, where is it that you will be most comfortable parking money? An array of names from which you will pick and choose.
Neeraj, I think first we need to look at businesses which will continue as it is irrespective of whatever happens.
So which are those?
So therefore that clearly leaves out the travel and tourism part, because right now 20% of your gross value added is coming from these, and they are bearing the brunt of the impact, which also means that they are probably putting, showing up the best prices. I mean, Indigo at sub 1,000. I mean, the airline is not likely to close down just because of the virus. Obviously, this quarter will be the worst, and that is what we are fearing even for global growth. Global growth will probably be, a contraction of about 1% in this quarter. But I think life moves on. So I think you will find the best risk reward in travel and tourism, but on a valuation basis, let's say, sectors like the metals, or for that matter, even utilities, most of these stocks are today quoting below book. And the fact that these are asset businesses which don't go away just because of a virus. Yes, there will be revenue impact. Revenue growth will be probably across the board impacted. But that again, if you just roll, say, probably a quarter out, things will start normalizing. So you don't buy it for today's situation and for today's price. The idea is, will these businesses continue? The answer is obviously yes. So I think you'll find these pockets. And plus, I mean, the market darlings, the Bajaj Finance, just a couple of months back, the QIP at 4,200 was massively oversubscribed. Today you're getting the same stock at 25% cheaper. So I don't see why there should be, these may be also great names to align yourself to. So is the case with SBI.
Right. All right. Lots more stocks to talk about, but also focus on the currency. The rampant sell-off in the markets globally, rupee depreciated to today it's record lows of 74.4 against the dollar. Let's discuss what could be the move going forward for the currency. We have Mr. K. Harihar of First Rand Bank who's joining us on the phone line. Mr. Harihar, record lows for the currency. Where from here? We've seen that RBI is taking steps to make sure that there is forex liquidity. What's your take on the currency right now?
Surely the rupee is under pressure, and I don't think there's going to be any immediate respite from that. I think the biggest pressure for the rupee is coming in from the fact that the FPIs have been selling in a very, very big way in this month. More than 30,000 crores across debt and equity has been sold, and obviously is leaving the country. So that is a very, very short-term pressure that's coming on the rupee. Offsetting that will be, of course, the fact that there are going to be huge savings coming in from lower crude prices, which could probably annualize even to as high as $50 billion. But that saving comes over the next, months and a year. So that will come in, and therefore the current account deficit, which earlier people are anticipating will be 1.5%, people are now forecasting to be below 0.5%, even probably 0.25% for the last quarter. So fundamentally, I think we are in an okay space, as in whatever you're going to lose on the FPI, you will make on the crude savings. But on the shorter term, sentiment is against you, FPIs are against you. And the overseas EM currencies are getting battered. So what is called popularly the NDF price. So if you look at those overseas traded prices which are there, they're very, very illiquid and very thinly traded, but that give you an indication of where the markets think they should go. So there we are seeing the rupee being 1 month rupee at about 75 rupees. So it gives you the trend where it's going. So where do I see the rupee? I think the rupee will trade with a weak bias, will probably go to that 74, 75 region. But as I mentioned, clearly the huge savings on crude imports and the fact that the other big import item, which is gold, has become so expensive that we expect gold imports to come down substantially, I think will mean that if you're an exporter, you should look to be selling your export receivables and at that 74.50 and 74.75 level, and locking in also to the forward premiums.
Right. Mr. Harihar, thanks very much. Great to have a quick opinion early in the morning, considering the fact that the currency is hovering around its record lows. Thank you very much for joining us with that perspective. Shubham Agarwal, a quick word from you. Taking a look at all of these names, and while fundamentally they are extremely strong, what would you do if you had to take a trade in the likes of a Bajaj Finance, an HDFC Bank, an Avenue Supermarts?
Devina, certainly not from a trading perspective. It is the time to recommend it to go with these. But yes, if the time horizon is good enough, and if we are comfortable holding on to the trade for the next 2 to 3 months, then I think it might make sense to buy after today's correction, because if at all HDFC Bank is available at a price of 940, 950, which was also a swing low some time back, where the stock consolidated for a very long time. So hopefully that should act like a support level where one can look to build some trades there. And even Bajaj Finance, if we see, then 3200 will be a comfortable level, so far away from the current level. So if I have to just pick one stock from this, all the three names, I would go with HDFC Bank. Around 950 is a price. If it is available, one should look to enter.
Shrikant, what about you? Any specific stock that you would look to trade today?
To trade again, it is very difficult because the way the market is now going to open, and yesterday the Singapore Nifty was down by some 1,000 points. So if we see further sell-off after opening, then it will be a very difficult situation for traders to take any trade. But yes, we are of the view that we should first focus more and more on those strong companies which have really done well and which have formed or made new high in the current run-up, like Bajaj Finance. So there, we feel that if we see any reversal pattern, then certainly we should look for adding Bajaj Finance. But at the same time, when the crash or sell-off was there in the year 2008, 2009, we saw first recovery in private banks and in auto companies. So we are going to focus more and more on private banks and auto. After if there is any stability or if there is any reversal formation on daily and weekly basis.
By the way, Mark, 8 minutes are done now, and mind you, while the Nifty is down 5%, the strongest names are now falling the hardest. So Deepak Nitrite is down 14%, 377. This stock has moved down in 2 double-digit falls from nearly 480 to about 377. HDFC, which was the all-time high, but I'm saying yesterday the levels were about 470 or 60 odd, from there to 377. HDFC AMC was down 14% yesterday, is down another 12% today at 2166. That's the extent of damage that you're seeing outside. And Jubilant Foodworks, by the way, is locked on a 10% downtick as well as we speak. What about the asset management businesses? People couldn't get enough of them. Right now, obviously, the sentiment is weak. Is this a good time to, or my question is actually, why are we talking only about buying? What's the extent of price damage that could happen to some of these businesses?
Neeraj, actually, the asset management companies are basically a second derivative of your market sentiment. So, when there is overall bullishness, you think that the flows will sustain, savings will be there. So, all that will add to the penetration story. Unfortunately, right now, the way the revenue outlook looks, that the extent of impact from this virus, how much would be actually coming off, and as a result, the kind of job losses, because when virtually half of the world is in a lockdown condition, I think businesses, it will be very difficult for business to function as usual. So I think we need to let a quarter pass. But having said that, it is quite likely that you'll probably see in the sort of reaction or exaggerated reaction, you'll probably see the pendulum swinging to the other side of the extreme. So earlier, when they were being valued, at a 25-30 times earnings compounders, today you might probably get them at 10-12 times forward. So one has to actually see as to where is the element of sentiment taking us. And today, actually, the news is still continuing to be worsening by the day. So I think that's where is probably that is adding to the fear. So I think from where HDFC AMC started, probably we could go all the way back, or who knows.
All right. I think HDFC AMC started at closer to about 1600 odd, so
Yes.
still some time away from that. But we never know.
2 days. Right now, it's a matter of 2 days.
All right. We're just minutes away from market opening, so let's tell you all that you need to know to stay ahead and trade today. SBI approves a 7,250 crore equity investment in Yes Bank under the RBI scheme of reconstruction. State lender says will remain within the 49% equity threshold.
Bandhan Bank will replace Yes Bank on the Nifty Bank Index from March 27th. The replacement is on account of non-availability of F&O contracts.
Sun Pharma to consider share buyback on March 17th.
Supreme Petrochem Board approves the buyback of up to 9.99% equity at 105 rupees per share, aggregating to 62.67 crores. The buyback price is a premium of 31% to the current closing prices on March 12th.
Bank of America Securities sees likely capex curtailment on virus scare impacting the industrial sector. Revenue visibility remains weak and costs are sticky. Cuts sector order flows to negative 20% in Q4 of FY20.
Okay, watch out for, well, names. I think that's all we can really do. But
Neeraj,
it looks very
some of these
ominous.
Yeah, some of these conglomerates, the Adani Group stocks, future group stocks. Obviously, Reliance in itself is down, but these are the bigger names, and Adani Group stocks were so active, just a few months ago.
Yeah, everything that was active is right now passive or in a coma mode. I mean, just the consumption names too, which have just been taking it on the chin. Almost everything is down. IT is down. Mid-cap IT stocks, Persistent Systems, large caps like TCS, HCL Tech, etc. Almost everything is being taken to the cleaners right now. Would IT be a port of calling at some point of time, or because of these travel restrictions, etc., you might actually see a large business impact?
Neeraj, actually, the travel ban hits tech to quite a large extent because, the onshoring, the entire travel, I think that probably people are still wanting to get a sense as to how are the companies viewing, because see, IT budgets would have been finalized, so therefore they have to plan for the next year hiring as well. I think so these are times when the timing of this incident is actually quite ominous in the sense that people, the outlook on the next year and the way forward is completely clouded, because in such cases one tend to get reactive, because the first thing is to keep the business stable as of now. So I think in IT even today, tech as a sector, because even in US now you're seeing that there will be definitely curtailment, travel has been restricted, trade is under pressure, so I think all that just builds up the pressure.
Okay, we're about a minute left to go for market closing. I don't know whether you guys have a top call, but if you do, Shrikant, what would it be?
Right now, though, we don't have any call. But the thing is IT stocks are certainly they are going to remain under pressure. But I just want to highlight one thing, that when the market was down in the year 2008, 2009 on the back of Lehman crash and all, there was thought that IT stocks are going to fall heavily and all, and very difficult for IT stocks to again regain. But later on, we saw the first sector which gained or which doubled was the IT. So this time also we need to focus more and more on IT, but right now the prices are still far away from their important support levels. So one more round of correction is not ruled out.
All right, Shubham, what's your take?
Not really a trading call, but I would go with HUL as a investment buy. May not be immediately, but around 1900 to 1925. If that is a level that we get in a bargain, then I think that will be one stock to look at from a portfolio perspective.
Well, that is a courageous call, I must say. But Shrikant and Shubham, take a moment to thank you for joining me today, gentlemen. Really appreciate your thoughts. Samir, we'll just take in an opening thought from you post-market open as well. But here's how the markets are starting off. We are some distance away from those circuit levels. So viewers, I had a lot of chatter on our feed as well about what are those levels. Remember, 939 or over 900 points for that is still some distance away. 6.5%, but that is still bad. And it's worsening. 2,200 points for the Sensex and 1,577 points for the Nifty. This is really bad. Following a terrible Thursday, we're actually having a really tough Friday morning as well. It's Friday the 13th, remember. The mid caps and small caps too would be starting off lower. I mean, you don't need to guess that, and should be all red. I'll be surprised if there is a green, but let's pull up any which ways. Yeah, all red yet again. Adani Port, HCL Technologies, Coal India now. I mean, everything that was being held out is taking it on the chin. Bajaj Finance is down 10%. 10% on open on Bajaj Finance. Maruti Suzuki is down 10%. You could argue that fine, that still has issues, but companies which have hitherto not had issues are really cracking up. Vedanta another 10%, Tata Motors another 10%. Well, now triple digits seems far away from Tata Motors. A while ago, it was debatable whether it will hit double digits or no. Reliance Industries is down about 9% as well. This is ominous. This is now worsening, and we are 750 points for the Nifty 50. Be mindful. It's still 200 points away. I don't want to scare anybody, but this is just starting off very weak. HCL Technologies is down 20% as we speak. GAIL another 16%. This is looking very, very bad. Sun Pharma down about a couple of percentage points. HDFC Bank is down another 4% as well. Bharti Airtel corrects 5%. Well, I can go on and on. My attention is caught in the Nifty 50. I'm forgetting there is a broader market out there, Devina, which must be corrected even more viciously. Okay, I think we are... No, we're still some time away, but these are the levels that people should keep an eye out for. The 10% circuit level for the Nifty is 8631, and which is about 200 points away. So another 200 points on the Nifty 50 or 849 points on the Sensex, and we will hit those circuits with still some time away. So hold your breath. Let's wait and watch if it happens. Devina, the broader markets, how are they looking?
Well, you're good as your guess as good as mine. You just take a pick on any stock you want in the Nifty 500, and it's down in the red, barring one stock. I think the last time I saw it was Lakshmi Vilas Bank. That was the only stock in the Nifty 500 which was in the green. That too now is gone down by about 4.5%. So everything is losing out. You've got Motherson Sumi down 21%. Syngene is down 20%. Ashoka Buildcon's down 20%. Just Dial's down 20%. Inox Leisure is at 257. I mean, when you saw Inox Leisure at about 380, you felt that it was time to start investing. Stock went up all the way almost 500, and there it is back at 250. Rain Industries, IFCI, that's a small penny name, so you won't even want to track it. But Sterlite Tech is down 16%. Imami is down. You've got All Cargo Logistics down 15%. Adani Power, Aegis Logistics 15% apiece. Banks have been decimated. Century Ply is down 15%. Sugar stocks are reacting. Tata Coffee is down 15%. Adani Enterprises is down. The likes of Dilip Buildcon, you've got RCF, Praj Industries, all of them, and there's no respite, there's no refuge anywhere. Vinity is down 10%, Spark is down 10%, Strides Pharma is down, Godrej Properties, Prestige Estates, Soba Developers, everything. That's a washout in today's session. So actually, Godrej Properties is not all that bad. It's just down 2%.
Well, but this is a classic fear template playing out right now. Sameer, this will sound repeated conversations, but the point is, since we don't know how long it will last, if you were to deploy money right now, let's say because you like valuations, perceived valuations, what quantum? Would it be 5-10% or would it be slightly more to take advantage of the prices?
Neeraj, actually, it would make sense for somebody to make in terms of fresh allocations, let's say go 1/3 all in today, and keep the powder dry for the balance 2/3, because right now what we are doing is probably we are somewhere around fair value in most of the stocks, but markets being markets will probably tend to do the excess on the other side as well. So we need to let the pendulum swing, the fear factor on the other side. I mean, optimism was one end and complete pessimism is on the other. So I think right now for most mid caps, there's also an element of this whole technical aspect of margin selling, etc. So wherever people have made a lot of money and where they were being kept as margins for leverage positions, I think right now nobody just seeing the price. People just want to sort of recover the margins and ensure that the positions can be liquidated so that cash comes in. So from a systemic point of view, I think what is happening is good from a market overall stability, but I think that will obviously give you a lot of good prices along the way. So one would probably go 1/3 right now and keep the powder dry for the balance for at least on the 2/3 fresh allocations.
Okay, well, so that is also a strategy because the prices are seemingly attractive right now. Thanks so much. Thanks so much for joining in today, Sameer. Really appreciate your thoughts.
Thanks, David.
And we need more of those during the course of the next few days, maybe. Well, we try and get you as many market voices, and on back of that, Suhas Harinarayanan, JM Financial Institutional Securities also joins us on the show. Suhas, thanks much for taking the time out. We are very close to the circuit levels, by the way. Suhas, just hang on. I just want to mark these numbers once. We are 73 points away from hitting the lower circuit on the Nifty 50. You got to keep that at the back of your mind. 49 points now. You are very close to those levels.
This could actually be very close. I mean, we're just a stone's throw away. 25 points. We could be hitting lower. And if we hit lower circuit right now, we're shot for 45 minutes from here. So 17 points and counting down to hitting lower circuit. 8,631.15. That's your circuit limit. That's your 10% circuit level. We are just about somewhere there. Not hitting it yet. Just teasing us around the
Yep.
All right. I think
we hit the circuit limits.
Yeah.
We hit the circuit limits on the Nifty, so we are 10% down. I think the last time that we hit this was a few years away. We are 10% down. Lower circuit on the Nifty 50. No more trades now for the next 45 minutes. This is a bit of unprecedented situation for a lot of people who are in the markets currently. But we've got a sane voice, thankfully, with us right now. Suhas Harinarayanan of JM Financial Institutional Securities joins us on the show. Suhas, good having you. Thanks so much for joining in. A few people were anticipating this, looking at the SGX Nifty levels yesterday, hoping that it won't happen, but it has. This is terrible, but your note says it all, right, Suhas? It's a bit of an unpredictable situation where we don't know what will happen next.
Yeah, that's true. I think it's maybe I'll have more viewers for the show now that the markets are shut for the 45 minutes. But having jokes apart, I think clearly unprecedented. I think it's quite interesting because I think a lot of foreign investors that we've been speaking to over the last few days, in fact, even last week, were actually far more negative than us, than a lot of Indians and Indian fund managers and some of us sitting in India. I think because they had seen this, if you take out the oil bit, I think they had seen this template of virus play out in other countries as well, where first there is only 1 or 2 cases, then 4 cases, then 6 cases, and suddenly it just multiplies. I think the reason I'm touching upon the virus is that seems to be the one big unknown at this point in time. Oil, maybe you can have a cost of production and below that probably it wouldn't settle substantially below that. The other financial, AS Bank, whatever related crisis, there's some resolution, we're waiting for a resolution, it's probably happening. So the clear unknown here is the virus bit, right? So I think having said that, just this morning speaking to investors, I could sense that, certain foreign investors are actually beginning to, buy into equities, specifically I would say the oil equities or the energy sector equities, right? Maybe not Indian oil equities, but I could sense that they are beginning to feel that the markets have corrected whatever 25 to 30% globally. Some of the oil equities have corrected a lot more. Maybe we don't want to wait for the bottom. Let's start investing a little bit. Right, so we were clearly behind the curve in catching the market. I don't deny that.
Right. Suhas, the reaction and the kind of ferocity in the reaction that we're seeing also comes from the fact that in previous times when we've seen market corrections, the ferocity and the pace has been slightly more graduated rather than so steep, is because from where we've started. We started at record highs, a decade-long bull market for the US equities, and that's where we've started the drop from. For the Indian equities as well, we made new record highs, and therefore the pace at which we're dropping seems to be that much more amplified. But now that you're witnessing this kind of a drop, which has not given you any exit opportunity of any sort, do you feel that much of it has somewhat been priced in? So even when you're talking about a slower recovery, this will eventually pass. It's a time-bound event. You're factoring in a slower recovery once this event is over. Now, with the levels that we are at right now, do you feel that much of that has been factored in?
I think good question. So the way the playbook that we are now using or using to discuss with investors is actually demonetization. We are actually saying this is like a demonetization for the world. If you look back at our own demonetization, the country went into a mini lockdown, especially rural India, SMEs, and real estate sector, right? Now we are talking of a mini lockdown for the world. And if you consider that playbook, what clearly happens is the small businesses will clearly get hit, because they can't, they're largely, don't have enough resources to survive for more than a month of lockdown, right? So clearly small businesses will clearly see a hit. Second, while that happens, we don't know how the leverage in the system, plays out. But having said that, the other big thing which happened during demonetization was the banks were awash with liquidity. Because there's no credit growth, there's probably easing going on in the market, right? So here you're talking of most central banks easing, although central banks cannot make vaccines, at least they can probably ease and provide enough liquidity, but there's no credit growth. So at the end of it, maybe I don't know when the end comes, 2 months, 3 months, 6 months, banks will be awash with liquidity, or the system will be awash with liquidity, right? And then you saw the big run happening in the markets in India, right, from early 2017 when all the mutual fund inflows started. So I would like to separate the economy part from the markets. Obviously, markets will reflect economy, but what would happen, I think, initially is all the liquidity will start flowing into markets at some point in time, right? So the playbook to be used is demonetization. And in terms of a recovery, it does look as if it could be slow because things like working from home, transportation, small businesses, travel, tourism, how it percolates down to different sectors, it's probably a little difficult to imagine, but it's probably apt to say that recovery will be slow for the world. Markets will, as is always the case, will probably recover faster than the economy.
Suhas, we were just having a word with Rhythm the other day, and he, in the morning itself, and he said that, while you might feel like you're in a dire situation of sorts, indicators are suggesting that, while earnings will start to come off, prices are looking extremely attractive. And while nobody can place a bottom, even if there is more pain that is to come into the system, deploying money bit by bit is not a bad idea. Even if you were to look at the global financial crisis, it took months before a bottom was in place. So when indicators started to trigger a buy signal, we still fell further. It took at least 5 or 6 months post that for us to make a new bottom and then pick up from there. But if you take a look at a longer term horizon, all that gets evaporated.
No, I think fair point. So I think, until couple of days back, one might have said that debt probably still a better investment than equities, given the growth concerns and given maybe multiples, maybe last week. But a week later, after the correction in markets, I would actually say that equities are beginning to look more attractive than debt, as you said, from a multi-year perspective, right? Now, whether you want to invest now, it becomes on your completely depends on your risk appetite, on your whether you have the money to invest. So I think if you were to ask me, equities are looking attractive. I think as I mentioned, certain investors are already beginning to buy into the markets. People who have cash or there's no cash call on them for the next immediate future. So we will see that trend. When it finally recovers, it's difficult to call, but I think this is a level at which we are beginning to believe that, and think that equities are clearly looking more attractive than debt.
I don't want to make comparisons, but I think we were closer to about 6,300 levels before the crash of 2008. And we seem to be seemingly close to those levels now. It just tells you that the panic selling that has come into the system, I don't know, and I'm unable to gauge, Suhas, whether this kind of a sell-off is warranted in any nature. Yes, it's a pandemic. It puts a halt. You've got countries that have been on lockdown. Businesses will suffer, but this is ultimately something that we can get over. Unlike the financial crisis, which came all of a sudden, it hit you in the face with the boom. There was policy reactions that did come in, but people were unprepared for that. This is something that has been building on. We're prepared for this, and we have the tools to deal with it as well. So this kind of a reaction, what's your sense? Is it a little wee bit unwarranted?
You know, honestly, difficult to say. I think whether it is warranted or unwarranted, we'll probably get to know. But I do think given the correction, equities are clearly more attractive than debt. It's not to say that markets may not correct further in the next 1 week. But that's precisely what I was saying. That the playbook to be used is I would the way we are thinking of it is this is like demonetization of the world, where you're getting into mini lockdowns for a few months. If you, at least I remember vividly walking across to ATMs, there was no cash, you couldn't do a few transactions, right? So, some of these things, how it percolates down into the actual economy, we'll get to know in the coming weeks. Already conversations with companies suggest that until Feb, there were no issues, but maybe in March, they're beginning to see some slowdown. But as you rightly pointed out, I think it's difficult to say how long this slowdown lasts. But I do think that there would be a little bit of an economic slowdown as a result of that, as a result of this. But I as I said, at the end of it, when you finally declare you're free of a lot of, or the number of cases start increasing at a marginal pace, you might actually end up saying that seeing that the system is awash with liquidity, right? And at that point in time, the move upwards also could be very, very sharp. Right? It's difficult to foresee that when it will happen, but if you were to go by how demonetization played out, that's exactly how we think will play out ultimately.
Suhas, maybe you have some calls, but since the markets are shut, we're taking the liberty of extending this conversation for 2-3 minutes longer as well. Now, just wondering, Suhas, have you been able to pencil in some fashion whatsoever, which are the businesses which are likely to, as things stand right now, by the way, with a presumption that things don't worsen, which are the businesses which are likely to see the least impact? Or is it very difficult to call that right now, even with your team of analysis and the access to managements?
No, I think defensives possibly is where you will see the least impact. I'm not saying you go and buy defensives now, but I think whether clearly a little bit of staples, whether it's pharma. I wouldn't put IT in that category because at least we went underweight IT earlier this week. Because we do think that valuations were not supportive of a likely slowdown, because travel gets hit. That's a big part of IT services. Order inflows could get hit. So I think IT somewhere actually where we do think both from a earnings expectation and market valuation, it's probably not justified. Probably going underweight IT makes sense. So clearly, but amongst the other defensives, I think be it in terms of the staples or pharma, even to a large extent on the utilities, we are not seeing much of an impact. In fact, telecom is another space where we do think there'll with more people working from homes, whether we don't know as yet. At least we haven't seen it in other countries whether data usage increases. But someone was telling me this morning that some country has told telecom companies to drop tariffs. I hope nothing of that sort happens in India, right? So I don't know which country this is, but we'll have to figure that out. But if something like that happens, then you probably have an issue with the telecom companies. But right now, telecom is also looking good to us. Right.
Yeah, so, it is.
So I think these are clearly the sectors where we do not see the impact. But I think some countries. Some sectors where we do think there could be some hit is clearly on the discretionary side. Travel, tourism, F&B, even probably anything related to coming to office, right? If this work from home continues for a couple of months or 2-3 months more, right? So then you might have some kind of a hit there as well.
Okay. Suhas, the couple of other questions, and just trying to make some sense of this, because the pace and the ferocity of the fall that we've seen has kind of taken a bit people by surprise. If this would have happened over 3 months, the pain would have been there. Maybe the shock would have been a bit less. How do you think your large institutional clients are behaving right now? Because I've got a very different picture. I mean, day before yesterday, Saurabh of Marcellus was saying that their endowment funds that they are talking to are actually now kickstarting the conversation of parking money here. Rhythm today morning was saying that there are people who are actually talking about India and Indian stocks in a positive way as well. What's your sense, both from institutional clients who are parked outside the Indian jurisdiction and therefore are FIIs, and institutional clients who are large money bags in India, and whether they are tactically looking to allocate more than what they have done in the past because of the SIP flows or otherwise?
I think a lot depends on the original positioning. Actually, in the beginning of the year, even before the virus struck, we did sense that India was no longer a hot market for FIIs. Even in our last, roadshow, international roadshow, we sensed that, normally when we go out for a roadshow and come back, we'll say, okay, India is TINA factor, so India, right? But actually, there were other markets which were looking better than India because India had not delivered on the growth promises that it kept or it didn't keep, right? So to that extent, I would say the positioning for many FIs would have been light on India because we did sense that a lot of funds that did finally come to India actually came through global funds or emerging market funds. The India dedicated funds hadn't received as much money, right? So I would say that positioning was already lighter. I won't say light, but at least lighter to start with. So they were probably overweight a couple of years, but they were probably neutral to underweight India in many cases heading into this correction. That's the way I think about India. So to that extent, I think if at all this correction is giving them an opportunity, but I still don't see them talking a lot more, sanguinely about India as much as, maybe, some global sectors per se, because they do think that I think India is still at the, India still got other problems to resolve. Right. So clearly, I think they're talking more about global sector calls, rather than specific.
Makes sense. And that was my final question, Suhas. For a global money manager, when his house is on fire or her house is on fire, why would he think about the outhouse? And therefore, currently, is it foolhardy to try and talk about when would the FI flows come back? Because right now, flows are moving out from all equity classes, all equities across the world, right? If they go back, they'll first go back to the first ports of call. That is one argument. The other argument is that almost all of those markets, US, China, etc., will have earnings issues big time in FY21. India may actually be an oasis of sorts because it might be relatively less impacted. What is a stronger argument to your mind?
I think if you look at the growth expectations on India, let's say before this, whatever issue started, I think people are building in a phenomenal 25% plus growth, for the Nifty for next year. About half of it came through tax cuts. Sorry, not half of it. About 7 percentage points probably came through from tax cut. About 7-8 percentage points from the lower credit cost for the larger banks. So the real underlying growth was, at a pre-provision operating profit, for the entire market was probably in the early teens, right? Now that probably takes a knock. You're probably looking at that getting cut. We haven't worked out our numbers because the system is still unraveling. So if you were to run with a scenario that probably gets hit, then you're actually saying that, it's not like India is an oasis of growth either. The reason I'm saying that is I think, from my conversation with foreign investors, while yes, India is getting more attractive, but I would think a lot of other markets are also getting attractive. Where we are seeing the interest coming to India is clearly possibly from sovereign funds and, certain other funds. We are seeing that kind of an interest coming through. But I think a FPI per se, unless he's an India dedicated fund where he was sitting on cash or he was positioned defensively and he thinks that the cyclical stocks are now looking attractive, where he might rotate out of defensive into cyclicals. unless you see money flowing in back to equities in general, into emerging markets and global funds, you're probably not going to see an increased allocation per se to India.
All right. Suhas, it was great chatting with you. What a historic day today. Thank you so much for joining us this morning.
Thank you. My pleasure.
Suhas Harinarayanan there of JM Financial Institution Securities. But, we're talking about historic days, and this definitely is one of those days. We've hit the first circuit breaker at 10%. I think we come back for trade at 10:05, and that's when you're open to the downside for the second circuit breaker at 15%.
Yeah, let's hope you don't have a black tongue, Devina. We'll show you those levels as well, viewers. But this is the 5-day performance as things stand right now. And as you can see, the quantum of cuts that we've had and the wealth destruction that we've seen. And while, Devina, you can argue that over 5 days, the weakest hands have fallen the most, there is no taking away the fact that a 17% cut on HDFC Bank is out of the ordinary. HUL is down 15%, Nestle is down 13%. Nothing's been spared.
This seems like profit taking because you are not worried about the fundamentals of an HDFC bank, right? Okay, an overhang of who will succeed, but that's not a reason why you would sell an HDFC bank, because you know there'll be somebody who will come to the helm who's going to be of equal caliber. But Hindustan Unilever, why would you sell a Hindustan Unilever? This is just pure and funds.
This is money moving out of risky assets into safe havens, and
across the board.
And which is why we've been saying the last 3 days that right now the money is not distinguishing between the good, the bad, and the ugly.
SBI
frankly.
at 200, SBI at 200.
200, and the mid cap space is looking even worse. By the way, this is a 5-day performance for the Nifty.
Just look about the Infratel.
Yeah, that's one holding out. But look at the broader end of the spectrum and the kind of gashes that we've seen in stocks again. And this shows you that there's no dissection between the large cap and the mid cap as well, because the top large caps have fallen between 30 to 50%. The top falls in the mid cap space too, between 30 to 50%. And there's no difference right now between what's large and what's mid. Even strong
everything is being met with the same treatment.
Sold into.
Varun Beverages, for one, that's holding out okay. I mean, in this market, which the index itself has fallen about 23% that's okay for itself. And some of these names which have fallen lesser than the rest. Whirlpool, obviously one stock which again is good on fundamentals, and you've seen a lot of positive calls on that one. But RBL Bank, I mean, you've got managements coming out and clarifying
that right now that
doesn't hold any water.
I'm just saying HDFC Bank would have come out and clarified, and the stock would have still gone and sold out. So RBL is a different kettle of fish altogether.
I want to look at the India VIX. I mean, what it
one India VIX, and then before we wrap up, the circuit levels as well, Devina. But the India VIX, please. Firstly, if we can get that up.
So yesterday's close for India VIX was, I think, around 41, 42. So I think now it's stopped. But this is where we are at 41, around 41, 42. Historic or not historic high, because during the global financial crisis, we've gone to levels much higher than this. But definitely in the last 10 years, these are the highest levels. And these are the next circuit break levels. I think the 15% circuit limit that comes at a distance of 472 points.
Yeah, so let's wait and watch if indeed we kind of dip towards these levels as well. These are the levels that will be important when we start off trade at about 10:05. But viewers, thanks for tuning in to this broadcast. We wrap it up right now on Indian Open, but we'll be back once the markets kickstart trade again with fresh voices.